Welcome to the March 4th, 2019 Advance Report for McGowan Group clients and NetWorthRadio.com listeners as we march forth into 2019. I'm your financial weatherman, Spencer McGowan, President, McGowan Group. We're going to walk through the charts and graphs that go with financial education and this week's market activity, primarily in the U.S. market today, and we'll talk more global at NetWorthRadio.com as we go forward. What do we have here? We got two charts, blue chip Dow 30 and the blue chip S&P 500, representing the broad, big blue chip market for the United States. I put 5 years up here so we could get a history here. See that 2015 correction there? That was earnings actually contracting to a rate of about $26 per S&P unit per quarter. And we're going to talk more about the earnings measure because it has to do with, of course, this rally beginning in 2016. You can see the post-election market here, and we go up about 40 to 50% depending on the companies if we look at the peak that we reached. And that peak, of course, was concurrent with the end of 2017, initially at 26.5 on the Dow. Then we went as high as 27,000 essentially, and then we had the mini panic of 2018. Well, the recovery hasn't made as much news, of course, as the panic, and that's usually true. I get more calls from media outlets when we've just had a panic, and then nobody wants to talk when everything looks pretty good. Okay, so we're at 26,000 on the Dow, about 900 points away from an all-time high. And this week's market activity, of course, was finishing the profit reports from the fourth quarter. And we got GDP news. GDP grew at 3.1%, and that's a 13-year high in economic growth, and that explains some of this recovery. This correction was more of a rebalancing. This more related to Federal Reserve pressure and the big theme of slowing global growth. So let's look at the impact on earnings. So here we see the earnings decline of 2015, concurrent with that correction we pointed out in the last graph. And then we see earnings per S&P unit. So if S&P is 2,500 or 3,000, it's in that range. Then we look at $25 per unit, $100 net after tax for that basket. That'd be a 4 or 5% earnings yield. And you can see this skyrocketing. Wow, goes all the way to $40. That's the end of the third quarter. Now the fourth quarter of 2018 actually showed that at less. That's a little perplexing to me because when we got fourth quarter reports, we actually heard they were up about 14%. Now we have a projection for Q1 and Q2. And Q2 is actually supposed to go down. Usually the analysts, they're a little too optimistic as opposed to pessimistic. How's the market going to digest this? That's one of the questions that'll help define the range for blue chip U.S. equity over the next year. Then earnings are projected to pick up and hit $45 per S&P unit per quarter after tax for the first time in history. And then the optimism takes us all the way to $50. Wow, that'd be $200 per S&P unit. If it was 3,000 at the time, may go higher than that. That'd be 15 times earnings. But this also says, wow, we got to define some kind of downside this year. And what are we going to do about it? Well, some of that may relate to the fixed income strategy. This is the high yield bond index. That's B-rated bonds. The category got the name junk bonds in the 70s during lots of defaults in the 73-74 recession. B-rated paper default rate tends to go to about 10% in a crisis like 2008 or 73-74, and there's been a few in between. All right. So we can see what happened here. High yield has the price risk, similar price risk to equity. That's a 2015 pullback. This being a 5-year chart, 2014. Then we see a rapid recovery in 2016 and on up. Well, what do you have in terms of total return versus the price? The price says we're about 86% of par value for the U.S. short-term corporate B-rated paper market. And it yields between 5 and 6%, depending on how it's counted. But the total return, 111. So this gives you an idea of total return with reinvestment versus just price. This price at 85% of par, 86% of par, that leaves room for some companies that might not pay their bills. Right now, that's estimated at 1 or 2% more average. In a recession, that'd go to 10. Well, that's still priced for a 10% default rate and actually doing pretty well on the basket over time. We won't like the market price when there's anxiety. And of course, you can see this recovery here. But notice the Dow and S&P are not at new highs, but with total return, the high yield index is at a new high. All right, let's take a little detour into Kraft Heinz. I think the message here is people don't like packaged foods. Kraft Heinz and Weight Watchers have just been pummeled in the current market. Oprah's brainchild has gone down as much as 80% from the peak. Ouch. That's Weight Watchers. This is Kraft Heinz. Warren Buffett brings the company back public with the Kraft Heinz merger back in 2015. Just a curious point. They said not as many people are going to buy weenies from Oscar Mayer, and the Kraft packaged product foods, that's in question. So they took a big write-down on the value of that combined business. And you can see the impact here from 2017 through today. Warren Buffett does not always get it right. This weekend's program will cover more from his iconic investor letter, great lessons from the master, and all of us make mistakes occasionally. This looks like one on Warren Buffett's part for his devotion to processed food, which is clearly in a bear cycle evidenced by Kraft and Weight Watchers. I'm Spencer McGowan, President, McGowanGroup Asset Management. Go to NetWorthRadio.com. You can fill out the preliminary client questionnaire for a 1-hour brainstorming at the Crescent or in a telephone conference call. Be sure to subscribe to YouTube McGowan Group for financial news and fast-breaking markets explanations with portfolio strategy. Thank you for joining us this week. My firm, McGowanGroup Asset Management, sponsors NetWorthRadio.com and, of course, our YouTube channel under McGowan Group. Some educational disclosures and discussions that I wanted to add to the broadcast. The first is, I'm very proud of our team, including Stephen Norris, who will be added as soon as we redo the picture. He's our newest team member. Come down, meet the team that cares, get a written plan, because the securities we discuss, the financial news we discuss, that's not a recommendation until you actually come down and get a customized plan at the Crescent. You'll get a tour, and we look forward to seeing you. We're going to cover value at risk of loss in portfolios, and you can see it right here. Learn about our performance, what happened in 2008, how long did it take to recover. All of those items are posted right here at NetWorthRadio.com or the McGowanGroup.com. The other part of the program, when we look at price fluctuations in bear markets and risk control, that's a huge part of NetWorthRadio.com. We look forward to helping you advance your plan and your cash flow. Come down and meet the team that cares.